If global finance becomes deeply tokenized, the biggest question isn't which asset wins, it's what actually settles the movement of value underneath it all. When treasuries, money market funds, corporate credit, and real-world assets live as tokens, something still has to quietly move value between them, close the books, and make transactions final. That quiet layer is where the real power lives. Right now, we're watching that world come into focus. On one side, tokenized U.S. Treasuries have climbed into the multi-billion-dollar range, with funds from players like Franklin Templeton and BlackRock experimenting with on-chain government debt. On another, the broader real-world asset market, everything from credit to real estate, has pushed tens of billions of dollars on-chain. Still tiny compared to traditional markets, but growing fast. Stablecoins now sit near the heart of that system, with regulated issuers targeting institutional flows instead of just retail trading. In this finale, we're going to ask one simple question. In a world where assets are increasingly tokenized, what settles the value that moves between them? And how could XRP and the XRP Ledger fit into that picture? Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. By the end of this episode, you'll have a clear map of the tokenized financial landscape, from treasuries and money market funds to institutional stablecoins and bank-issued tokens. You'll see how ETF issuers, asset managers, and banks might use different layers: ETFs, stablecoins, RLUSD, custody, and XRPL, to move value in ways that feel almost invisible from the outside. And you'll understand how XRP could function as one of the settlement assets inside that world, not the only one, but a meaningful part of the plumbing. Earlier in this series, we covered how XRP ETFs actually work, how liquidity really moves, how institutions allocate, and how Ripple spent years building an institutional engine around RLUSD, prime brokerage, custody, and treasury systems. This finale doesn't reteach those topics. It pulls them together and asks what kind of system they might be quietly pointing toward. Today, the financial system is quietly shifting into a tokenized model. Think of three broad buckets. First, tokenized treasuries and funds. Dollar-based government securities, wrapped in on-chain form so they can move 24/7 or sit inside on-chain collateral systems. Second, real-world assets, or RWA. Things like private credit, real estate fractions, and money market funds issued as tokens on ledgers, instead of just in custody accounts. Third, settlement tokens, stablecoins, bank deposit tokens, and institutional cash instruments that move value between everything else. The numbers are still small compared to the traditional system, but the trajectory matters. Tokenized treasuries have jumped from under $2 billion to well over $7 billion in just a couple of years. RWA platforms now track tens of billions across multiple chains. And stablecoins, still dominated by consumer-facing names, are seeing more institutional attention as regulators lay out clearer rules and as banks experiment with their own on-chain cash instruments. None of this guarantees success, but it shows that the idea of financial assets as tokens is past the experimental stage. Zoom out, and the pattern gets clearer. Traditional finance is not replacing itself overnight. It's building bridges, issuing tokenized versions of existing instruments, connecting them to custodians, and then layering liquidity and collateral tools on top. Underneath all of it, something still has to serve as the settlement rail, a place where value actually changes hands and finality happens. That's where ledgers, including XRPL, come into play. Underneath all of this activity, something critical is missing in most public conversations: the idea of a settlement layer. You can have tokenized treasuries, stablecoins, and ETFs, but without a predictable, high-throughput way to move value between them, you end up with islands, useful, but fragmented. Settlement layers are the bridges between those islands. A good settlement layer has a few non-negotiable traits. It needs fast and reliable finality, so that when value moves, the books actually close. It needs fees that are low and predictable enough to be built into institutional workflows without surprising anyone. It needs strong guarantees around uptime and consistency so that treasurers, funds, and banks can rely on it. And increasingly, it needs compliance hooks, identity tools, credential systems, and issuer controls that make regulators comfortable with putting serious instruments on chain. That last part is where 2025 has been especially important. The XRP Ledger has been adding features aimed squarely at regulated tokenization, multi-purpose tokens designed for institutional assets, native support for automated market makers that talk to the order book, DID, and credential standards to handle identity and KYC in a privacy-aware way, and issuer tools like clawback for certain token types. These don't change XRP itself, but they reshape what can be built on Ledger, especially for issuers of bonds, funds, and other regulated instruments. In other words, the settlement layer of the future is not just fast and cheap. It's fast, cheap, programmable, and compliant enough for institutions to put real balance sheet items on top of it. That's the bar XRPL is trying to clear. This is where XRP and the XRP Ledger, or XRPL, come into the picture. If you watched Part 4, you saw how Ripple built a stack around RLUSD, custody, Ripple Prime, and Treasury systems to give institutions a familiar way to plug into this world. RLUSD is now a billion-dollar-plus regulated stablecoin, issued through a New York trust framework, with circulation split between XRPL and Ethereum, and early pilots involving major banks and payment networks. On top of that cash rail, Ripple Prime has launched spot prime brokerage in the US, giving institutions a place to execute OTC trades in assets like XRP and RLUSD, with custody options tied back into regulated vaults and trust structures. Combined with Treasury integrations through platforms like Treasury and ongoing bank charter ambitions, the picture starts to look less like a single crypto company and more like a small, specialized financial system, one that happens to be built around XRPL as its underlying ledger. So where does XRP itself sit inside that architecture? Three main roles are plausible. First, XRP can act as a bridge asset, the thing you briefly hold in the middle of a cross-ledger or cross-currency transfer. Second, it can serve as an optional settlement asset for certain flows, especially where participants want a neutral token rather than one issuer's liability. Third, it becomes part of the liquidity fabric for tokenized FX, Treasuries, and RWA trading, moving between liquidity pools, market makers, and OTC corridors as institutional products expand. None of these require XRP to replace anything. They just treat it as useful plumbing. Importantly, this is not a winner-take-all story. Other chains, CBDCs, and bank-run ledgers will absolutely be part of the settlement landscape. XRPL and XRP are competing for specific roles, corridors where their speed, cost, and regulatory posture line up with what institutions need. The more those corridors expand, the more structural rather than speculative demand becomes. Zoom out for a second and look at the product layer, because this is where everything starts to click. We now have multiple XRP-linked ETFs, real-world asset funds issuing directly on public ledgers, and even tokenized money market funds being tested on XRPL using RLUSD as the cash leg. One example involves a major Asian bank, a large US asset manager, and Ripple, accredited investors trading a tokenized money market fund against RLUSD on a digital exchange. That's basically a traditional fund share that can now move like a token. On the surface, these just look like new tickers and fancy product codes. But underneath, they form something much more interesting: a multi-issuer, multi-wrapper ecosystem. You've got spot XRP ETFs, income-style XRP products, trust vehicles, tokenized funds, and stablecoins, all pouring into overlapping liquidity pools. It's the ETF world meeting the tokenization world. And the more issuers that join in, the deeper the liquidity gets. Deeper liquidity naturally pushes everyone toward common settlement rails, which is where XRPL sits, quietly stitching the whole thing together. In that kind of environment, XRP's role isn't to be the shiny product. It's the plumbing behind the scenes, the part that helps trades settle cleanly, keeps cross-border legs in sync, and lets liquidity desks rebalance across different wrappers without friction. That's a very different way of thinking about XRP than the old speculative asset narrative. This is XRP as the connective tissue in a growing, tokenized financial marketplace. Now let's talk about the people actually steering this shift, because once you understand their incentives, the whole system makes a lot more sense. ETF issuers care about fees and being early to new categories. Asset managers care about whether tokenized assets genuinely make things easier. Better collateral handling, faster settlement, fewer headaches. Banks care about reducing risk and cost without picking a fight with regulators. Regulators care about transparency and stability. And Ripple, along with other infrastructure builders, cares about making its rails the easiest, safest place for institutions to plug in. When you put all those motivations side by side, a clearer picture snaps into place. Issuers want more products that tap into shared liquidity. Banks want rails they can monitor and trust. Regulators want ledgers with built-in compliance tools instead of add-ons. And Ripple wants RLUSD, XRPL, and XRP sitting right at that intersection, the place where tokenized assets are issued, traded, settled, and reconciled with as little friction as possible. That doesn't mean XRP becomes the settlement asset everywhere, but it does show why XRP and XRPL are being engineered to be compatible with that role whenever it makes sense. One of the easiest ways to picture this is to think of an airport hub. Each airline is like an issuer: ETFs, tokenized funds, stablecoins. Each flight is a transaction. Passengers are units of value moving through the system. XRPL is the airport itself: the runways, gates, scheduling systems, and ground crews that make everything take off and land smoothly. And XRP, it's the fuel. Not the destination, not the airline, but the thing that keeps the whole operation running when routes intersect and volume gets heavy. Sure, you could run an airport with multiple fuel vendors, but once one of them becomes deeply integrated into the daily workflow, it naturally becomes part of the core infrastructure. Let's walk through 3 reasonable futures. These are scenarios, not predictions. Thought exercises to understand how the system could evolve. In the conservative scenario, tokenization grows steadily but cautiously. Tokenized treasuries keep expanding. Some RWA platforms find product-market fit, and regulated stablecoins like RLUSD continue to gain share in specific corridors. XRPL becomes one of several ledgers used for settlement. XRP plays a role in particular niches, maybe in certain cross-border payment flows, tokenized fund platforms, or specific regional corridors, but remains one asset among many. Demand is real but measured. In the moderate scenario, adoption accelerates. More asset managers launch tokenized funds on ledgers that support institutional features. Banks and corporates begin using stablecoins and deposit tokens for real workflows, like intraday liquidity or cross-border treasury operations. XRPL's institutional features, multipurpose tokens, AMM plus order book integration, credentials, clawback for certain tokens, make it an attractive venue for regulated RWAs and money market funds. XRP is used more often as a settlement and bridge asset inside those XRPL corridors, and ETF products quietly sit on top of that liquidity. Structural demand grows, but the system remains clearly multi-chain. And in the ambitious scenario, but worth considering, a more coordinated settlement architecture begins to emerge. Tokenized treasuries, RWA funds, and institutional stablecoins converge on a smaller number of ledgers that meet strict regulatory and operational requirements. XRPL, supported by RLUSD and Ripple's institutional stack, becomes one of those preferred hubs. XRP is widely used as an intraday settlement asset, sitting in the middle of flows between tokenized money market funds, stablecoins, and cross-border corridors. In this world, demand for XRP is driven less by speculation and more by the need to hold working inventory for settlement and market making. Even in that ambitious scenario, reality would be messy. New rails emerge, regulators change course, other chains innovate, and macro cycles speed things up or slow them down. There is no straight line from today to institutional settlement layer. But thinking through these possibilities helps frame what XRP's role could be, from niche tool to meaningful corridor asset to one of the fuels that keeps a tokenized financial system running. 5 episodes later, we can finally see the full picture. We started with XRP ETFs and what really happens behind the scenes when you buy a share. We moved into liquidity and flows, separating visible exchange balances from the deeper invisible plumbing of OTC desks and custodians. We stepped into the world of institutional behavior, model portfolios, risk committees, hedge funds, family offices, and treasuries, and how they actually decide when to allocate. Then, we opened the machine room and walked through Ripple's institutional stack, RLUSD, Prime, Custody, Treasury integrations, and the XRP Ledger as the settlement fabric underneath. This finale zoomed out to the global level. Tokenized treasuries, real-world assets, institutional stablecoins, deposit tokens, and on-chain settlement rails are no longer theory. They are quietly being built, piloted, and scaled. Within that evolving system, XRP and the XRP Ledger don't have to be everything. They just have to be useful, reliable components of the plumbing. If they are, then XRP's long-term story becomes less about headlines and more about how much critical infrastructure ends up routed through this particular ledger. For you as a viewer, the goal of this series was never to tell you what to buy. It was to give you a clearer map of ETFs, of liquidity, of institutional behavior, of infrastructure, and now, of the tokenized future those pieces are quietly building. With that map in hand, you can make your own judgments about where XRP fits, what risks matter, and which scenarios feel most plausible to you. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.